All right, we got a big crowd today. So very excited. Perfect day to be talking about this with Powell speaking in just about an hour and a half. We are going to talk about all things lending, but really what that means is we're going to be talking about the market. We're going to be talking about inflation. We're going to be talking about what we think is coming and what has been happening and where we are today. As always, our goal at Wealth and Rentals is to bring you education, events, mentorships, masterminds, and consults to help you on your real estate investment and financial journey. I encourage you, if you haven't already joined our Wealth and Rentals podcast or subscribed to our YouTube channel, please do so. We have a fantastic content coming up over the next few months. Actually met with the team this morning. Very excited things coming out in the coming days. Can't wait to share those with you, especially as we come into not only a just crazy year in the financial world. I think we all kind of know that's what's coming, but also an election year, which just makes it even more crazy. So again, I have a lot of information coming at you frequently, keeping you up to date on what's happening, but also most importantly, the opportunity of what's to come as interest rates start to come down. We just had our bus tour last week. It was a huge success. We have 3 more upcoming, January 26th, March 23rd, and April 26th. You can register for those online. Each of those is an all-day event, and you'll get to see our top markets and where we are investing with our own personal investment journey. As always, everything we're going to talk about today is based on my best guess and years of experience, not only as a real estate manager, owner of a real estate company, and also someone who really just deals in all things financial. That said, I'm not a lender. I can't give you lending advice. I'm not an attorney. I can't give you legal advice. My goal is to be one tool in your toolbox and to help connect you with those who can give you guidance on your journey. 3 of those people are here today, the best 3 people I know in the lending world. All are experts in their form of lending and also in the financial markets. And that's why I'm very excited to have them here with us today. So the first thing I want to do is give each of our speakers just a quick moment to introduce themselves. If you've been listening to me, you've heard all 3 of them speak before. They're all fantastic. I personally use all 3 of these people. And so I can't speak highly enough about not only what they do in business, but also their character. And of course, for me, being family owned and operated, that's paramount importance to me as well. So Wade, I'm going to let you go first. Tell everyone just a little bit about yourself.
Sure. I've actually worked with Leah quite some time. I've been a client of hers and she's been a client of mine. So definitely appreciate all the kind words. I'm also a real estate investor, passionate about the single family space, single family 1 to 4. And we also have a company that's built around that particular part of the industry. We focus in that single family 1 to 4 and then also up to 9 unit multifamily spaces with a real passion for helping people succeed by avoiding some of the mistakes that we've made over the years and also by taking advantage of the things that we've done well. And the last thing I'll say is that we really focus on not only being in the short-term space, but in the long-term space. So we have a hard money lending company that's really focused on value add through knowing the markets very well and helping you succeed. And we offer both conventional and DSCR or no income doc long-term loans.
Yep. I can tell you that if you are looking for DSCR, Wade is absolutely who I recommend you contact. He's got amazing programs. I tell people all the time, I wish I had not just done 30 or 40 with him, but more like 150 or 200 at that time, because I think you locked me at what, a 4.25 for 30 years on DSCR, didn't you, Wade?
It was really good. And in that moment, you and many others, myself included, you never thought the song was going to stop playing. It was such a good run, but here we are, a year and a half later, and then rates are almost doubled, and we all wish we could go back in time, but that happens.
Hindsight is always 20/20, but one of the things Michael always says is the next best time is now. And I think truly that is the world that we're living in right now.
Absolutely.
All right, Daniel, those of you, if you've been listening to me for years, you know that Daniel got me started on my investment journey. He was the lender who did my first 4 investment properties, and we've been working with him for a decade. Just fantastic, fantastic guy. I'm proud to call you my friend. All of you are my friends, obviously, but Daniel, I've known you a very long time, and you've been integral in my entire investment journey, and I can't thank you enough for that. Tell our group a little bit about yourself.
Yep, this is going into my 23rd or 4th year in lending now. So started off with the subprime stuff and was able to weather that storm and come out of it and created where we are today. And we're down to 15 loan officers now. I've managed I've had underneath me as many as 100 loan officers before. So when I say I've seen every scenario and anything you can think of when it comes to lending, I've seen it all. We've done it all. We've been there through the thick and thin of it. There's not many things that I can't tell you where to go or how to go or who to get it done with or who's going to get. And Leah knows this. If we've talked many a times, and I've told her that's a better option. You got to go that direction. There's just sometimes, people have better options. And that's one thing you'll get with us is I'm never going to try to force you into something that I know you can get something better somewhere else. We'll tell you what your best plan of action is and help you on that journey. I'm always available when it comes to just asking questions. I get tons of texts. I mean, I eat, live and breathe real estate just like Leah. So, people are like, well, I don't want to bother you. It's your weekend. But with me, if it's on the weekend, I'm probably looking at properties anyway, or I'm doing something to do with real estate, period. And so it's not a bother to me just to shoot me a text. I mean, I'll respond. If I'm unavailable, I may not respond for an hour, 2 hours, whatever it is, but I'll get back to you. When it comes to, with Leah's, it's funny because our relationship started off with a Facebook post. She posted something on Facebook and it was, and I was like, man, there's no way can't be that hard for her. So I said, and it was like 10 or 11 o'clock at night. And I said, well, if you give me all your stuff, and if you can get it to me within whatever, I'll have you an answer tomorrow. And while we were on messaging, she's like, I just sent it all to you. So I went ahead and pulled my email up and got my laptop up. And I was like, this is not complicated. I don't know, whatever issues you're having, I promise you they're not issues. It was funny because Leah, through the whole process, are you sure? No, I've been told that this is going to be an issue. I'm like, no, I promise you this is not an issue. And then, here she is now with 50 million plus in real estate. So good job.
Thanks. It's funny. Those were the days after the crash. I use that word lightly because it really, in Texas it wasn't, but they didn't want to lend to real estate agents. And so it was a different world for
a lot of people still to this day frown upon doing multiple transactions at one time. Yep. So you can run into lenders with really good rates, but then when they realize you're trying to do 2, 3, or 4, or 5, or 10, they're like, no. So yeah. That's one of the things that we don't frown upon. So.
Yep. Either you qualify or you don't. It's pretty simple.
Yeah.
All right. Well, and then last but not least, Willie Merritt. Willie is absolutely incredible. He's with a direct bank, and so a little bit different than the other two that you've already heard from. Willie actually is the one, for those of you who follow me on Facebook or have come to our events, he's the one who did my new home, and he's done my vacation properties. Daniel's done vacation properties too for me. Just fantastic products. Again, all three wonderful people, and just so blessed to work with all of you. So Willie, please tell us just a little bit about yourself and about your bank.
Yeah, thank you. I've been in the mortgage industry, a little over 20 years, and started off in the subprime space and kind of transferred over to A paper. And like Daniel said, if you do high volume, 20 years experience, you get like a gold star if you have a scenario that we haven't run across. They're far and few, but luckily we've had 20 years of seeing it all, just to offer some expert advice on how to get around certain scenarios and how to get across the finish line and sign the closing documents. I've been at the bank for going on 5 years in February, and we're primarily a commercial bank, but the beauty of relaunching the mortgage group in 2019 is I came into a platform that really hadn't been in existence for 5 years. I mean, it was blank slate, so we got to regrow it from the ground up, and the bank gave me the reins, and we do everything from portfolio lending, construction, one-time close. We have the ability to correspondent and pretty much all agency loans, so it's the best of both worlds here, and it's just a great opportunity, and things have been really, really good, and getting to work with you and your group has been absolutely phenomenal.
Well, thank you. I appreciate that. One thing you'll find with all three of these people that we have on today is they all believe in the journey, they all believe in the model, and they're all living that. And so that's really important to me. I think there's a lot of people out there that they talk about what they do, but they don't actually do it. and they talk about how you can do it, but they're not actually doing it. And then the people they connect you with aren't actually doing it. And so what you'll find is that the people that we send you to, the people that we liaison with, these are people that they believe in the power of real estate, and specifically the power of long-term single family rentals. And that's really important, because I think if someone isn't living that journey, they don't truly understand what it is to not only own them, but to cash flow them, to 1031 exchange them, to continue to build that. And this model of defer, and using 1031 exchanges to take one pot of money and turn it into a larger pot and a larger pot, it's really a foreign concept. And when you do it on a large scale, it becomes even more foreign, because the push is multifamily. So what we do is unique. What we do is a little different, and it's just wonderful to have people who believe in that journey. They believe in that model. They're seeing that model come to fruition every single day and making it happen for the people that we're here to do it for. And so all of that is just paramountly important to us. So thank all three of you for that. So really why I brought everyone here today is just to talk. And we don't typically do webinars like this. Usually I've got tons of slides for you and lots of information I want to show you and things I want to say and discuss. But today I'm going to pull up a few charts. We're going to pull up some data, and we're just going to talk. Because at the end of the day, we're in unprecedented times. All of us have been in the industry a really long time. Daniel, you've got a few years on me. I think this is my 18th year, but we've all been through a recession. We've all been through a crash. We've all been through the ups and downs of what an election year brings. What we all haven't been through until now is the post effects of COVID and the printing of money that our government did for years. And really that's what we're seeing now. What we're seeing is an economy that halted. We're seeing an economy that was artificially kept afloat. We're seeing tons and tons of money that was printed and put into circulation that never should have been there. And this is not a political statement. It is what it is, right? And so at the end of the day, it's, well, now how do you bring this back? How do you, descale this economy without crashing it? And so as much as we all kind of harp on the Fed and their stupid comments and everything else, they have a very tough job right now. And I certainly don't envy them for that. And there's just a lot of things happening right now, specifically today, of course, because you've got Powell speaking shortly. But Daniel, why don't you kind of kick us off here, and we'll just take it from there. So this is one of the things you just provided me that's talking about the kind of inflation guide of what's happening. So talk us through this.
Yeah, so core CPI came in today, and it was actually flat. They were expecting it to come up just a little bit, came in flat. It's actually it's good news for us. I think we've been on the right path for several months now. When you talk about like what is the Fed going to say? What are they going to do? So the markets are already looking at, and we do a lot of stuff on the back end when it comes to looking at mortgage-backed securities and notes that are being sold out 6 months out down the road. So it's crazy because I can kind of see where we are, what we're looking at 6 months down the road, and that's kind of where we think that things will change significantly for us. It may even actually happen sooner when you get into talking about like the election year. I don't think. And this is just my personal opinion, and talking to some, I got kind of lucky. I ran into a hedge fund guy that works for Goldman Sachs, and these guys deal in billions and billions of dollars. And the first thing he started doing was talking to me about mortgage-backed securities and what he thinks about to happen. I didn't bring it up. He asked if I knew what it was. He goes, "You know what mortgage-backed securities are?" I started laughing. I said, "Well, I know a little bit about them." He goes, and he just kind of went into it and was telling me what he thought was about to happen. As long as we keep getting these inflation, the CPI and the PCE data coming in, and it is every month it's coming down where it's supposed to be, and it's actually they're anticipating something and it comes in a little bit lower. So we're on the right path, right? So that's all this is telling me. We're doing the things that the rate hikes have done what they're supposed to do. The only thing that is kind of lagging behind is probably the employment data, but the employment data throws me off because it doesn't throw me off. It angers me because they always come in. They do throw these numbers out, and then they come in a month later and they revise it and like, oh, it was actually a lot worse than what we thought. And if they would have gave us that data in the beginning, you would have had a lot better read on your CPI and everything else. So it's just crazy how it's all set up and back to the hedge fund guy says, he says, and that, whether this is true or not, is that the Democrats are they're very concerned about Joe Biden being their candidate. this next year. And what they want to see is if they give him 4 months of just a booming economy, which the housing market has to start booming for you to consider anything booming here in the United States. So they want to see, he says, watch, and he told me, mark his words. He's like, call me in January. The Fed's going to start buying mortgage-backed securities in January. And the reason they're going to do that is because you know what happens then, rates drop down, and they will, if they start doing that, it's not just going to be a gradual trickle down in rates. You're going to see a significant dip in rates. And so if they start doing that and they give Biden 4 months of data, so this is what they say they want to see. They want to give him 4 months of data and repoll in April and see where he stands, because that gives it, and if that doesn't help his numbers or his standing, that gives them enough time to roll out a new candidate for 2024. And I can't disagree with that. I honestly, I'm like, man, I find it hard to believe that they are just going to, in January, that they would do that, start purchasing mortgage-backed securities. But I also don't put it past them to feel like that's truly what the plan is. So when it comes down to it, you know, even without that, we're heading in the right direction. And then, you know, Jerome Powell's going to talk today. He's going to say, don't count on the rate cuts, but you know the rate cuts are coming. You know, he's going to say, he's going to say, don't count us out on raising rates one more time. I don't see how you can do that, you know, but it's what he does, and it's just what you gotta see through. And then it takes the markets a little while to digest. And you know, I've got several people reaching out, what should I do? And my advice right now is lock in these gains that we've got for the last couple of weeks and just kind of move on down the road. And you can show them later the difference in, you know, refinancing, what the rate does on a $300,000 balance, just the difference in payment, what your savings will be, and all that good stuff. So other than that, that's kind of where we are.
I mean, Willie, that's the same advice you've been giving. You've been telling everyone it's day by day, hour by hour, really more than anything.
And what Daniel said is exactly how it is. It's like the first week of each month, employment data comes out, and it's, you know, the jolts, and then it's the jobless claims, and then it's ADP payroll, and then it's non-farm payroll, and it's just this movement. And then the next week it's, you know, the CPI and everything comes out, and it's like the opposite of what one would think. And then you have GDP the following week. So, and then there's the correction. So, you know, some data may come out and then the market tanks, and then 2 weeks later it's corrected, and it's like, oh, well, here's the adjustment. Now all of a sudden the rates drop or they tank. It really is day by day. So you look at everybody's situation, and if they're comfortable floating, you just kind of give them ranges, you know, risk versus reward. They're not risky, lock. If they want to play the market, it is what it is. Just, you know, I look at the dollars instead of necessarily the rate. A lot of times it doesn't really change the payment that much. So we log in and just renegotiate if the rates drop. But like Daniel said, everything really is moving in the right direction. And the dot plot has everything going down with the FOMC's forecast for, you know, 24 and 25. So cost of funds should go down, rates should go down, inflation should continue to go down. So like a broken record, just keep buying and take advantage of refis when opportunity comes up.
Yeah. Wade, what do you think Powell's going to do today?
I think he'll talk about lowering rates in the future. I think he'll mention it. That's my guess. I think that they're preparing for an election year. Whenever you think about the impact of lowering rates, it takes a long time to influence inflation, but it will very quickly impact the stock market. The average American, who, you know, most people do have a 401k of some sort at least, or they're invested somehow in the stock market. So a lot of people's perception of how the economy is doing is often based on how the stock market is doing, which is really a bad way to do it, but it is something that lowering rates can impact very quickly, and people can have more of an optimistic viewpoint on things, and is probably realistic. So based on previous election years, I really see them lowering rates, you know, maybe early in the year. I don't know exactly when that would be, and that making a big impact, because you're already starting to see that in the bond market and the projections, that there are projections for those rates to be reduced a little bit earlier than we may have anticipated a few months back. So I think
so let's look at that. I actually, while you're talking about this, I actually pulled something of what everyone is saying they think is going to happen. So if we look here, and you'll notice that this is brand new, right? So all this just came out. The experts are unanimously agreeing that rates are going to come down next year. And so you've got the black line here on the left is what's been happening. And then on the right, you've got your four top, or five really: Fannie Mae, Redfin, NAR, the Mortgage Bankers Association, and Wells Fargo. And this is their projections. Look at that.
Hmm.
It's almost like everyone's finally in agreement that it's time to cut rates. Like I've been saying, and you all have been saying for a year, as we're going into the election season.
Yep.
Yeah, and I don't know, Leah, if you saw the home price expectation survey, the HPES, their panel over, I think the panelists consist of 100 individuals in the housing and mortgage industry. They're projecting rates at the end of next year to settle around 5.7, and I think that's actually lower than that last slide you had up.
And look at what they're showing home prices are going to do. And this is the thing we've been talking about, right? It's, you can always go refinance a property, but what you can't do is manufacture lower prices again. And so when we look at the data, this is what we're seeing. We're seeing that experts are now in agreement, which they were not in agreement 3 months ago, but they are now in agreement that prices will rise next year and rates will come down. The question becomes how quickly and how much. So even if we look at home sales, they're even, other than Fannie Mae thinks new home sales are going to flatline beginning of Q1 and Q2 and then go back up. But everyone else thinks it's going to be a straight rise. And NAR is extremely optimistic, which I think is very accurate, because we know there's 14 million home buyers sitting on the sidelines. And so what are these home buyers going to do? They lost out last time rates went down. They've now seen the volatility that they did not understand because they really weren't alive last time this happened. And so the question becomes 14 million on the sidelines the minute homes become affordable again. And remember, guys, we don't have to be back at 5% or 4%. That's not what we're talking about here. We're talking about the smallest drop makes a huge difference. I mean, you three tell me, just the last few weeks as rates have come down, what's happened with, sales, what's happened with mortgage originations?
Yeah.
My phone actually, go ahead. My phone actually started ringing again. So it's been, it's been a challenge. It's no doubt about it. When you have close to 8% rates, we were sitting around here, it's like, should we go to second lunch? What are we doing today? You know what I mean? It's been dry, but the minute they start coming down, it's funny because then the emails start trickling in, start getting the text. Hey, I heard rates dropped. People don't understand. They see the headlines, but they don't understand. Like, they did drop, but it's not anything. It's not what you're looking for yet, right? I promise you, when it's what you're looking for, you'll be the first person I contact. But we have, and it's across the board. Every loan officer, I feel bad for a lot of our guys just because, some people didn't listen when I told them in 2020 and 2021, save all your money. This isn't normal, right? We're in an artificially low rate environment. This will go away. Don't go out and buy every new car and thing you can. Let's save your money. Some of them didn't, some of them did. But it's good to see them, actually coming into the office and being excited for, getting 2 or 3 apps in a day versus 2 or 3 in a month, which is kind of where we had been. So the activity is picking up, and just the fact that people are tracking it and reaching out to me before I even say anything and saying, hey, what does that look like? Where are we at now? Does it make sense? And, some people are, so it's not just people that, made the conscious decision of, I'm going to wait till rates come down. This just isn't palpable for me, right? It's just not something I want to do. There's a lot of people that just don't qualify at an 8% rate or a 7.5% rate. So I probably have 40 people that need a mid 6 or a low 6 rate, and not on a temporary buy down basis to actually qualify and buy a house, right? And those people are reaching out left and right going, are we there yet? So they're just waiting for a 6 anything, and they're back in the game. So that's the activity is definitely picked up.
One thing I want to talk about is, most of the people on the phone today are not necessarily looking to buy primary. They're looking to invest. And we get these questions all the time. I'm going to wait until the market corrects. I'm going to wait until the market corrects. And I think what's really been proven is that if the home prices did not come down at the interest rates we've been at, they're probably not going to come down at all. That's the simple reality of it. And a lot of people will have already missed the boat. And I think whenever you're investing, there's 2 factors, right? There's You do not have to see a reduction in home prices to get good deals. People have been getting really good deals in this market because there's less competition, and the discount on the ARV is way down from where it was whenever rates were, 4% on an investor loan. That's the simple reality of, people might pay at that point 92.5% of the after repairs value on an investment product, and nobody's on investment home. Nobody's doing that right now. Nobody's paying 92.5%. That's not what you have to pay. You can pay significantly less. So people who are focused on ROI and understand that investment is really a function of how much money I put into it and the returns I can get, instead of just focusing on cash flow, are really the people who are doing well in this market. And if you think about it, people that were investing in 2009 through 2011, the numbers did not look fantastic at the moment, but they looked amazing down the road. And the only time you can get those outsized returns is whenever you're in a market that other people are afraid. And there are a lot of people who are afraid right now.
I was just talking to Daniel before we started. We actually, this last month was a record month for us. And it's interesting saying that, right? Because most real estate agents that do traditional real estate are really hurting right now. And so one of the things a couple of people have asked me is, well, why? The answer is because savvy people, investors, understand what's about to happen. We have no crystal ball, there's no guarantees, but those of us in the market know rates are about to go down. And a little bit down means prices go up. A lot down, which is what now all the experts are calling for, means prices go a lot up. And then you pair that with the fact that Texas is uniquely positioned, massive housing shortage, record number of jobs, more people renting. So there's a bigger push needed for rental properties. And then of course, the areas that we're working in this odd year, they're up 8-9% in appreciation. So everyone gets so fixated on, well, I'm only going to make 150 a month or 200 a month cash flow. But what they forget is that 10% or 9% appreciation this year, that was 20 grand. So that's far more valuable than what the cash flow we're talking about is. And then once you refinance when rates drop, cash flow goes back to normal. And so I think it's kind of like everything in life. People get very short-sighted, they get very narrow visioned, and they focus on the here and the now. And one thing I can say about all four of us on here is we are all long game players. And, that's something that I think has served us well. I know, Wade, you've got a massive portfolio like I do, and we buy right. We buy at the right time. We buy the right product, but we don't stop when people are afraid. We speed up. I've got 9 properties pending right now, 9 units closing in the next 2 weeks. So, again, it's back to we have to do what makes sense right now, but keeping an eye on what makes sense for the future. And I think summer is going to be to heights we've never seen. I think North Texas is going to go to heights we've never seen. If even this, all of this and these interest rates, which are actually quite normal, if you look at the charting, we all know that this really isn't that high. Talk to my husband's mother had a 13% mortgage rate she took out in the 80s. I mean, this is not that uncommon. What is uncommon is the housing shortage that's been building for almost 50 years in a metro that adds 300,000 jobs a year. That's what's uncommon. And so at the end of the day, we're all super lucky to be in Texas. We're super lucky to understand the dynamics of the market. And the biggest takeaway I want all of you listening to understand is that this is not going to be the case much longer. And in reality, Daniel, you and I have been out there saying rates are going to come down any day. You called it, I called it. This year they would start coming down some. And it doesn't take a Fed rate cut for rates to drop, guys. All it takes is the sentiment that rates will be coming down, and then investors will start negotiating their rates to try to lock things in before it goes down. So we're not waiting for the Fed to drop their rate 2%. We are only waiting for the Fed to say we're done raising. And then the floodgates open. And the real problem is those floodgates, it looks like are going to open at the same time that prime season hits. And so it's going to be a double whammy for all of these home buyers sitting on the sidelines.
It's going to be more than a double whammy, because you have what's happened in the mortgage space is you've got probably 50 to 60% reduction in staff. So all of a sudden you get an influx of 200 files. How are you going to process those? Who's going to underwrite them? There's so many things that are going to exacerbate the problem. Then you're looking at 30, 60, 90-day locks. I mean, it was in 2021 where some places were taking 60 to 90 days to close a loan when everything went crazy. So you'll run into issues not just with the housing, but then you're going to have, there'll be lender issues where it comes down to who can handle the influx of business, who's going to be poised with the right amount of staff that can, it's one thing to have a great rate, but if you can't deliver and close, to make your sellers like, I'm not doing a 90-day close. You need to find somebody else, right? So it's one of those things. It's one of those things that you're going to have. There's going to be a lot of different things in play when it comes to when rates drop and things go crazy. And we said back in 2020 and 21, I think me and Leah talked a bunch and said when rates were, you could get a primary in the 2s and an investment in the low 3s. We're like, I can't believe people should have bought as much. You should have taken on as much debt as you humanly possibly could. Then, I mean, it's just, I told everybody, it's like, they're like, what would you do? And I was like, I would take everything I had, which I basically did, and just start rolling it into real estate. And it's going to work out for you, I promise. And it went, so you're going to have a lot of things come into play, and it's not just the shortage. It's not just rates dropping, because I think you'll start seeing also a lot of lenders go in and maybe not even offer the rates as low as they could be, because you just can't handle the influx of business.
I mean, Wade, when we did the big refi and the boom with all those properties, some of those appraisals were 6 weeks, because the appraisers were so backed up. I think we're going to get there again. And there's a lot that got out of the business too. And we're not even thinking about that. The last 6 months has scared a lot of people off. They just couldn't afford to stay in. Lenders, processors, appraisers, inspectors, they've gotten out. And
appraisers have been an issue that's one of the biggest dying breeds out there. That's why Fannie Mae and Freddie Mac they've tried to automate and streamline a lot of this. So they're taking a lot of automated valuation systems now, because an appraisal is just a dying breed. They just are not participating. And it's not like, used to, you'd have appraisers with 3 and 4 apprentices. Now most of them don't have any. And so it's
surveyors the same way. Getting a survey is like 3 weeks right now.
Yeah, and there's no business.
No, so imagine what happens just in prime, even if the rates don't drop, which I don't believe that's going to happen. We're not prepared for prime. We're just not. And we're kind of in a world where a lot of jobs are having these issues. I'm not entirely sure where everybody is. I mean, there's so many jobs open everywhere. There's more jobs than people to fill them. I don't exactly know where everybody is, but I know they're not doing what we think they really should be.
Yeah.
Crazy times.
So I've got a couple other things I wanted to show. So this is kind of what the last 30-year average has been, starting 2014 to now with rates. And so I want you to kind of see what we're dealing with, what's been happening with these rates, because it feels really, really harsh, but you also can see that we're just not that far off.
No. 2019, we were about to take off. I think you would have saw, if COVID wouldn't have happened, I think you would have saw rates in the 6s on a natural progression of where things were going, and people bowing out of buying the mortgage-backed securities. But COVID hit, and the government stepped in and they bought, they increased their MBS purchasing by, I think it was like 10x back then, and it was, here come the 3% rates.
Yeah, no, for sure. And, this is another way to look at it. So you've got the monthly, the 3-month, the 6-month, and the year over year. And you can see our inflation target is that big black line. You can see how much progress we've made. I mean, this isn't a question of if they're going to cut rates. It's a question of when. Really, I think the biggest change is that now we're seeing vehicle costs come down. Oil and gas was our largest driver when we were still close to 4%. And now that gas prices are starting to come down, I think that, which is really strange when you think about the fact that there's quite literally a quasi-war going on in the Middle East. You would think gas prices would be up, but it just goes to show how strange everything is right now.
Leah, do you get any kind of reports on like apartment rental costs, like in DFW for a year over year? I've talked to a lot.
DFW is still quite affordable, which is really interesting, but it's way up.
I've seen like I talked to someone the other day, and there's a friend of mine's kid. They're 22 years old, and he told me he was paying 22, and this is not a nice area. He's paying $2,200 a month for a 1-bedroom, 1 bath, like Preston and Beltline area, not far. I was like, man, that's great. He's like, it just,
Yeah.
he's like, there's nothing available out there for like, if you want to spend like 1,500, you're not going to be in the safest area. I was like, geez, that's
This is why we operate in affordable housing, right? Because there's such a shortage of it, and it's getting worse. It's going to be critical levels here. I mean, y'all know we're going to be the largest metro by 2100, and so we're going to overtake New York, LA, and soon to be Chicago. And right now, we're still average home price under 400,000. What is going to happen to DFW? Y'all can put me on the record, record this, whatever you want to do. When we look back at DFW today and where it's going to be in 30 or 40 years, it will be historical. It will be LA. It will be exactly what happened, except it won't be a bubble. We are so undervalued by market size and economy size. It's unfathomable to me. I just don't even know what we're looking at. What I know is that all of our kids, there's going to be an affordability crisis. It's already started.
Sure. And you look at the amenities, if you ever look at the affordability index and the cities that are at the top, the cities you're talking about, Miami, least affordable, then you've got New York and all these other cities. The average income in those areas is often less by a pretty large margin than the
Yeah.
Dallases, the San Antonio, maybe not as much San Antonio, but to a certain extent, but definitely Austin, Dallas, and to a certain extent Houston. The incomes are often greater than those other cities where home prices are literally 2x, maybe even more. And then all the other factors, state income taxes and gas prices are exponentially higher. It's just so much less affordable that, to your point, if people want to have a reasonable lifestyle, they have to move. And then whenever they move, they get comparable, if not better, amenities, right? Like it's not like you're giving up culture or restaurants or other. You might be giving up, beauty to a certain extent compared to California. But, other than that, horrible weather in Chicago and in New York. So if you look at all the factors, it just makes sense for people to move. And that's why they're doing it in droves.
100%. And cost of living index here in North Texas is like 102 to 104. You look at areas like San Francisco, LA, you're 120, you're 124, but the cost of doing business, the number's even bigger. It's so much cheaper for businesses to operate here, and that's just why they keep coming. And that's before we incentivize them. And then that's before you look at these heightened growth areas like the tech corridor that we work in. And so I think there's no doubt Texas is unsurpassed. It's unique, it's resilient, it's just an incredible thing. And I think the biggest takeaway here is you have to remember it's hyper local. It's hyper local. You can't compare one market to another. You can't compare Dallas to Orlando or Dallas to Vegas. It's very different. Same thing with Houston. Houston's doing great too. And so, at the end of the day, I think we're all in a consensus. Rates are going to come down, prices are going to go up, housing inventory is going to get worse, and we're going to have a very volatile election year.
It's gonna be one for the records. I know I don't like election years just because of all the just crap that comes along with it, but this is gonna be something that you'll never ever forget. You'll probably talk about it for the rest, especially with what are they gonna do with Trump? There's so many things out there. It's insane. What are they gonna do with Biden? We're in uncharted waters. It's gonna be interesting.
We are. If nothing else, it's going to be a show that we'll get to enjoy. Hopefully not to the negative detriment of our country, but it's interesting times for sure, financial world and otherwise. And I think this is really what everyone else is saying too, though. For the first time, I think in a year, people are starting to be on the same page, and that's really important, right? Because it gives us all better tools to go guide people, and it keeps people from getting bad advice and bad guidance from other avenues too. So while we wrap up, I'm going to open it up to Q&A. You have a question box there. If you have any questions, things you want to ask, topics you want us to address before we end for the day, please feel free to put that in there. Otherwise, I thank all of you for being here today. I thank all of you for working with our clients and helping them build and me build my financial journey. And Willie, I especially thank you for locking my jumbo at 2.75.
Your file comes across every month as a red margin, and I get to look at that, and it's like we can't wait until that rate adjusts. I think we did 63 jumbo like one-time closes sub 3, and we have all those, so it was great when it happened, and now it's looking at it like those loans will stay on our books until the rates adjust.
Oh yeah,
regardless.
Like, nope.
Yeah. It's awesome. There's a lot of people that jumped on that. That was a great product.
Yeah, absolutely wonderful. Well, I don't see any questions here. So, oh, I see one here. Let's see. So we are invested in Denison, Amarillo, and with Grow Developments, which is our real estate investment fund. Are there other areas you should be looking in? So I had investments in Florida. I sold because I saw the bubble bursting. COVID artificially increased Florida to a point I wasn't comfortable. I think it made short-term rentals look a whole lot better than what they were, 30 to 40% in my opinion. So I did liquidate my Florida properties. I am 100% invested in Southern Oklahoma and North Texas. And so I'm probably the wrong person to ask that to, because I am all eggs in, all 40 million in on this little 70-mile radius here. I have one property in East Texas and one in Waco.
What part of Southern Oklahoma are you in, Leah? What are you?
Yeah, so everything that's within 30 to 45 minutes over the border. So I own in Thackerville. I've got two more, actually 2 fourplexes closing in Thackerville in the next 2 weeks.
Did you build those new ones out there? I talked to that guy years ago when they started doing those. They built a couple and then they wanted to just sell the lots. And I saw you posted, you were like, will you build it? So did he build it for you?
Yeah, we've got a development being built right now.
Okay.
Yeah, and then so Durant so if you go up the 2 main highways, right? So you've got 75 and soon that's going to be 45. They're just changing the name. And then 35, we're over the border off both of those highways. It does great. We've actually got one of our builders off market is doing brand new construction right by Choctaw, right up 75 in Durant and Kalika and all those areas. And it's a great area. We love it. And the housing shortage is so extreme in Grayson County. It's going to get so extreme.
Will you send me the builder stuff, anything for the Choctaw Durant area?
Yep, you got it. Yeah, you have to remember, and so Gainesville on the other side over the border, Gainesville's gone up some of these areas 20%, even with everything going on, and rents are just through the roof. And so, TI's first, they've got 4 semiconductor factories being built, right? So they've got 4 different areas. The first one's going to be online in less than 24 months. Globotech is in process, and now you've got Finisar doing a multi-billion-dollar expansion. What's going to happen in Sherman and Denison is going to be unprecedented. I've got a question. Is purchasing lots of first-time investment smart? No, absolutely not. I do not. I own 0 lots. Well, I take that back. I have a package of single families in Collin County that came with a lot, and all of their septics drain onto said lot. And so I just haven't dealt with it because I've been busy. So I own 1 lot, but it's unintentional. Let's see. As the process of purchasing a home, should we shop around for loans? Will that affect credit if multiple entities are doing a check? Somebody want to take that one?
Mortgage inquiries are set up to within the first 30 days to kind of recognize as one hit. So it's not like car shopping or credit cards where you can get instant credit type of things. The bureaus actually recognize a mortgage credit inquiry and allow you to have multiple pulls and not affect you.
Yeah, and really for the most part, your credit score should be comparable to one another. You have to remember that I always go off of your bills. If you get a credit card statement mid-month, that's when they report their data to the credit bureaus. So if you were in a situation where your cards are maxed out and Daniel pulled your credit at the beginning of the month and you'd paid off that bill, well, mid-month is when it reports. If I pulled your credit later in the month, I may have a higher score, or vice versa. You max out a card and I pull your credit and the scores drop. Your scores didn't drop because I pulled your credit report. It dropped because your credit utilization dropped. So the increase count is 1, but the data is still, at the time it reports, that's going to affect the credit scores.
Another thing that's popular right now, which my company is doing, and I don't know if the other gentlemen are, is we're able to do soft pulls to get you qualified, and then whenever we're actually moving forward, we can do a hard pull, which is really nice for investors in particular.
We just started doing soft pulls too. Some people are, requested, so we can do a soft pull that doesn't hit you. It doesn't give you a hard inquiry if you're in the preliminary stages.
Yeah.
We're just trying to kind of see who sometimes it's just, you talk to somebody and you're like, you don't want to deal with them, right? It's sometimes simple as that. Some people find me offensive. I'm sure everybody has the same thing. So, so you can avoid that by doing the soft pull thing. And one thing I will say, and I don't know, Willie or you guys, I don't know if you have noticed this, but good Lord, people are buying what's called trigger leads. So we have our own little system in place to try to block that, but A trigger lead is the minute a mortgage company pulls your credit report, the bureaus, Equifax, TransUnion, Experian, they sell that information saying, hey, this client is shopping for a mortgage. And if you've ever applied for a mortgage before and they've got your data on file, so phone number, email address, I've had clients tell me, and we actually had to go in and create some stuff within our systems to block them out. But I had one client get 31 calls in a day after I pulled their credit and didn't do my little button where I block everything out. So that's one thing I'd be conscious of. I would talk to whatever lender, whoever you deal with, even if it's not one of us, just say, hey, do you have anything in place to not get my data sent to 50 different lenders and my phone blowing up every 5 seconds?
I usually just put your contact info in for the email and phone number. We'll pull credit.
Yeah, but I'll start putting Willie's phone number in there. Oh, Willie.
All right, I've got another question here. So I'm about to jump into the North Texas model using the OmniKey model. Following your model, what will happen if there's a shortage of homes in 2 to 3 years, and how do we double our portfolio, go to a different undiscovered market? So we keep broadening our reach, right? So where we were 5 years ago is different than where we were today. But remember, most of what we do is off market. These people build and sell directly to us. So even when there was a housing shortage last summer and the year before, we always have inventory. And I can promise you, if we ever run out, I'll go build it myself. Let's see, I've got a couple people asking if we're going to send out the replay. Yes, we'll have the replay out this afternoon, and it'll be posted to all of the channels later on today. So I do want to remind you, if anybody has questions, follow-ups, I do consultation calls 3 days a week. And it's like a 30-minute call. We charge, I think, $125 for those. It's a great way to kind of get started with a plan for your portfolio. I encourage you, if you haven't done one with me yet and you're working with our team, certainly I think would be a huge benefit for you. But also, if you have questions that you want us to tackle on webinars or things that we can answer on social media for you, please email them over to us. I'll put this up one more time, the contact information for all 3 of our speakers today. They're all a wealth of knowledge, and I know them all well enough to know that if you have a question, whether you're working with them or not, they are more than happy to help you. Let's see, I have one more question. Is getting a loan as an LLC with multi-members different or more difficult than if I was a single person looking for a loan? Wade, I'll let you take that one because you're the LLC lender here.
Sure. There's 2 different types of loans that we offer. One would be a hard money loan if you're purchasing something with the intent to repair it. And certainly that's very easy. It's done in-house, and you can borrow it in LLC. And if you have multiple members, we can discuss who would have to be on that loan as a guarantor. On long-term loans, if you are over a 50% owner, almost all long-term DSCR lenders are going to want you as a guarantor. Some, they're going to have a policy of over 20% ownership, but there are some ways potentially if the primary owner is very strong to where all members may not have to do a personal guarantee. But I know Leah's a big believer in almost everything she does. She does personal guarantees. Some people pursue not having to put a personal guarantee, but you're going to get better products if you do that. And borrowing in LLCs with a DSCR loan is actually a very easy process in many ways. We do conventional loans as well. That's a more taxing process in a lot of ways, although you're typically going to get a better product.
Yeah, the only time that I typically see people do a non-personal guarantee is when we're doing IRA lending, because they can't come after anything but the property. But the reason I'm not a fan of personal guarantee is twofold, right? If you're not willing to put your name on the line, then you're probably not someone I want to work with. And number 2, why do a product that's going to give you a worse rate? It just doesn't make functional sense to me when the goal is to maximize cash flow. So I'm not a huge fan of that product, but then again, we all lived through 2007, 2008, so we probably are a bit more gun shy. But yeah, there's plenty of wonderful products out there, both in personal name and LLCs.
Yep.
All right, let me make sure we don't have any new ones after that. A bunch of thank yous. I appreciate everybody, and thank all 3 of you for being here today. Again, this will post here in just a little bit, and if there's other topics or things that you want us to cover, please let me know. We're about to have our New Year's series drop. Can't wait to share that with you guys, and I'm sure I'll be seeing some of you again soon in the future for those. Otherwise, I hope everybody has a wonderful rest of their week and weekend. Happy Hanukkah for those of you who are Jewish like me. And other than that, happy holidays, Merry Christmas. And we will see everyone at the beginning of next year. Thank you so much.